Welcome to our deep dive today. We're going to be tackling something that's often overlooked, but it's so important, and that is trading psychology.
It really is.
You've given me some great material to work with here, and so I'm really excited to kind of unpack it all with you.
Yeah.
We want to improve our trading, and we're going to be looking at the wisdom of Mark Douglas to do that. He's like a legend in this field.
Yeah.
And he had these incredibly insightful principles, but I think what's fascinating is how he kind of arrived at these.
Well, yeah, his story is an example of how we can learn from our setbacks.
Yeah.
You know what I'm talking about? Like his silver trade in the 80s,
Yeah, right.
where he missed out on like a $400,000 profit because of, well, his emotions got the better of him.
Okay, 400,000. That's a hard pill to swallow.
I know.
Like, oh man. So that just shows you how much our psychology can affect our trading. So before we kind of dive into the specifics, what would you say is like the ultimate goal of mastering trading psychology? Is it just winning every trade?
I wish it was that easy.
Right.
But no, it's all about achieving consistency.
Okay.
Consistent profitability, that's the holy grail.
Right.
That's what we're after. And that comes from eliminating those costly errors that we all make,
Oh, yeah.
and developing a systematic approach that you can rely on trade after trade.
Okay, so it's more about having a process that you can trust than it is just getting lucky with a few big wins.
Absolutely. Having a process is everything. And Mark Douglas knew this. He used to challenge traders to try this experiment, trade the exact same strategy on a simulator and a live account.
Okay, yeah.
The difference in performance was remarkable.
Really?
People made way more mistakes on the live account.
So it's like the pressure of real money completely changes the game.
Exactly. It's like two different worlds.
That makes sense. But how do we bridge that gap? How do we start thinking and acting like we're in a simulator even when there's real money at stake?
That is the million-dollar question, and that's where Douglas's 7 principles of consistency come in. These are like the building blocks for developing that winning trader's mindset.
7 principles. Okay, I'm ready. Hit me with the first one.
All right, the first principle is objectively identifying your edge. Now, an edge is simply a setup or pattern in the market that has a higher probability of working in your favor.
Okay.
It's about understanding the odds, and that's what gives you the confidence to take calculated risks.
So you're not just randomly buying and selling. You're waiting for those specific moments when the odds are tilted in your favor.
Exactly. You're a sniper, not a machine gunner.
But how do you actually find that edge? It can't just be any random pattern.
Right. Your edge has to be based on something concrete, like a back-tested strategy or a pattern you've observed and studied over time. Let's take pullbacks in an uptrend as an example.
Okay.
Let's say you've back-tested this strategy and found it has a pretty decent win rate, maybe 60% or even higher.
Okay.
That understanding, that knowledge of the probability, gives you the confidence to pull the trigger when you see that setup forming.
So it's not just about hoping for the best. It's about having that data, that evidence to back up your decisions. That's a great starting point. But even with an edge, things can go wrong, right?
Oh, absolutely. And that's where the second principle comes in. Predefining your risk before every single trade.
Okay, I've heard this before. That sounds a lot like setting a stop loss.
That's it. It's like your safety net.
Right.
Imagine driving a car without a seatbelt.
Yeah.
It's incredibly risky, right? The consequences, well, they could be disastrous.
Yeah.
Trading without a predefined risk is pretty much the same thing.
Yeah. Okay.
You're essentially leaving yourself open to potentially catastrophic losses.
So a stop loss is like our seatbelt, protecting us from those big crashes. But even with a stop loss in place, accepting that you could still lose on any given trade, that's a whole other challenge.
It is. It's a mental game. And you've hit the nail on the head. That's precisely what the third principle is all about. Completely accepting the risk or staying out of the trade.
Okay, so it's not enough to just intellectually understand that losses are part of the game.
No.
You have to genuinely accept it, like emotionally.
Emotionally, 100%. Douglas breaks this down into 3 levels: intellectual acceptance,
Okay.
execution,
Uh-huh.
and confidence.
Oh, wow.
First, you intellectually grasp that losing is inevitable.
Okay.
Then you act on your strategy despite that knowledge. But the real test: maintaining confidence in your system even after a string of losses.
I can see how that third level would be incredibly difficult. Have you ever struggled with that? With maintaining that confidence after you've experienced losses?
Oh, honestly, yes. Especially early on in my trading career, I used to panic and exit trades prematurely, especially when things started moving against me.
Yeah, I think we can all relate to that. Seeing your account balance in the red could really trigger those like fear and doubt responses.
Yeah.
So how did you manage to kind of overcome that panic and develop the confidence to stick to your system?
Well, it definitely takes practice, but for me, journaling was a game changer. Okay.
By recording my trades and the emotions I felt at the time, I started to see patterns in my behavior.
Okay.
That self-awareness helped me develop strategies to counteract those impulsive reactions.
So it's like having a record of your emotional journey as a trader, allowing you to identify and address those patterns that might be holding you back.
It's like having a therapist for your trading.
Yeah, that's great. That's a great tip.
Yeah.
And that ties in perfectly with the next principle, right?
It does. Principle number 4 is acting on your edge without hesitation. Once you've identified your edge, set your stop loss, and made peace with the inherent risk,
Yep.
you have to be able to act decisively when that edge appears.
This is where I think self-doubt can really creep in. You start second-guessing yourself, and then all of a sudden the opportunity is gone.
It's like a thief in the night stealing your profits. Doubt often stems from a lack of confidence in your system.
Yeah.
Or from the fear of being wrong.
Right.
But here's the thing. The more you hesitate, the less confident you become. And it becomes a vicious cycle. Yeah. So the key is to build that trust in your system through practice and backtesting. The more data you have to support your edge, the easier it is to act decisively when those opportunities come knocking.
Data is your friend. Trust the numbers. Now moving on to principle number 5. Paying yourself as the market moves your way.
This is, I think, where it gets really tricky.
Oh, I know.
It's so tempting to let those winning trades run and run,
Oh.
thinking like, maybe it'll go higher.
Just a little bit higher.
Right. How do you find the discipline to take profits when everything inside you is screaming like, hold on for more, hold on for more?
That's greed talking. And it's a powerful emotion. Remember, the market doesn't care about your hopes and dreams. It can turn on a dime.
Yeah.
And those paper profits can vanish just as quickly as they appeared. Taking profits along the way, it's like locking in those gains.
Right.
And it protects you from giving back those hard-earned wins.
That's like the old saying, bulls make money, bears make money, but pigs get slaughtered.
Exactly. Don't be a pig. Have a plan for taking profits and stick to it, even when it's tough. Now, the 6th principle is a bit of a mouthful. Continually monitoring for susceptibility for making errors.
Okay, break that down for me. What does that actually mean in like practical terms?
It's all about constant self-awareness. You need to be your own worst critic. Always on the lookout for those moments when your emotions or biases might be leading you astray.
So it's like having a little voice in your head saying, wait a minute, are you sure you're making this decision for the right reasons?
Exactly. That little voice is your best friend in trading.
Okay.
It's the voice of reason reminding you to stick to your plan and not let your emotions hijack your decisions.
All right, last but not least, principle number 7, the absolute necessity of the principles. This one seems pretty self-explanatory.
Yeah.
But what's the key takeaway here?
It's not enough to just understand these principles intellectually. You have to live them, breathe them, make them an integral part of your trading process.
So it's like a holistic approach. You can't just cherry pick the principles that you like or you find easy to follow. They all kind of work together to create a solid framework for your trading.
Right. It's a complete system designed to help you overcome those psychological challenges that sabotage so many traders.
These 7 principles, they are really insightful. And it's amazing how something as seemingly intangible as psychology can have such a profound impact on our trading. But wait, there's more to Douglas's wisdom, right? Didn't he also have like a set of rules about probability?
He did. He had 5 fundamental rules about understanding the inherent uncertainty of the market. And I think they'll shed even more light on why those 7 principles are so crucial.
Perfect. Let's dive into those rules and see how they all connect to the bigger picture of mastering our trading psychology.
Let's do it. So, these rules really get to the heart of why so many traders struggle.
Yeah.
It's like they're trying to fight against uncertainty instead of embracing it.
Okay, so rule number 1, what's the first step to kind of embracing that uncertainty?
Okay, it's deceptively simple, but often overlooked. Anything can happen.
And anything can happen.
At any moment in the market, no matter how good your analysis is, how strong your conviction is, the market can always throw you a curveball.
So even if we have a solid edge, we've got a well-defined strategy, there's no guarantee that a trade will go our way. It's like that element of randomness.
Totally.
It can really mess with our minds.
It messes with everyone's minds. And that's why it's so important to remember rule number 2. You don't need to know what's going to happen next to make money.
Okay, hold on. So are you saying that we shouldn't even try to analyze the market or make predictions? I mean, that goes against everything we've been taught.
Okay. I'm not saying that analysis isn't important.
Okay.
It's crucial for identifying your edge, remember.
Right.
But obsessing over being right about every single price movement is a fool's errand.
Yeah. Okay.
Remember, we can't control the market.
Right.
We can only control our own actions and reactions.
So instead of trying to predict the future, which is impossible, we should focus on probabilities and managing our risk.
Bingo!
That's the key. Okay, that makes sense. But I'm still kind of struggling with this idea of randomness. If I have a good system, shouldn't my wins and losses follow some sort of logical pattern?
That's a great question, and it brings us to rule number 3. There's a random distribution between wins and losses for any given trading edge. This means that in the short term, your results might seem chaotic.
Right.
You might have 5 losing trades in a row, even with a strategy that boasts a 70% win rate over time.
Wow. Okay. So even with an edge, we have to be prepared for those stretches of, seemingly bad luck.
You do.
It's not necessarily a sign that our system is broken.
Right.
It's just the nature of probability playing out.
It's just math doing its thing. And this ties directly back to Douglas's principles of consistency. Having a predefined risk.
Right.
Accepting the possibility of loss. And acting on your edge without hesitation. These principles help you weather those periods of randomness and stay focused on the long game.
That makes so much sense. It's about detaching from the outcome of each individual trade and focusing on the overall strategy.
You got it.
Okay, so we've got an edge. We accept that we don't need to predict the future, and we understand that wins and losses can appear random in the short term. What's rule number 4?
Rule number 4 is a good reminder. An edge is nothing more than an indicator of higher probability.
Okay.
Remember, your edge doesn't guarantee a win on every trade. It simply tilts the odds in your favor over a large sample size.
It's like flipping a coin that's slightly weighted.
Exactly.
You're not going to win every flip.
Right.
But over hundreds of flips, you're likely to come out ahead.
Exactly. And that brings us to the final rule, number 5. Every moment in the market is unique.
Okay, isn't that kind of similar to rule number 1? Anything can happen.
They're definitely related.
Yeah.
But rule number 5 goes a bit deeper. It highlights the ever-changing nature of the market.
Right.
Patterns and trends emerge and disappear. What worked yesterday might not work today.
So we need to be adaptable.
Absolutely.
Constantly learning.
Yes.
And adjusting our approach
Yeah.
based on, the market's current conditions.
You're getting it.
Okay. I think I'm starting to see the big picture here.
Good.
These rules, they're all about embracing that uncertainty.
Yes.
And adapting to the market's kind of ever-changing nature.
It's a dance, not a fight.
But how does this all connect back to Mark Douglas's own trading journey? Specifically, that $400,000 silver trade that we talked about earlier.
Yes, his silver trade. That story perfectly illustrates how violating these rules, and by extension, his own principles can lead to costly mistakes. Remember, he entered that trade on his broker's advice.
Right.
Not because he had identified a clear edge. He was essentially gambling, not trading.
Right, and he didn't have a stop loss in place.
Huge mistake.
So when the market moved against him, he was exposed to, unlimited risk.
Exactly. He violated the principle of predefining his risk, and it cost him big time.
And he didn't seem to really understand the market context either. He didn't recognize that silver was stuck in a trading range, which ultimately limited his profit potential.
You're right. If he had a better grasp of chart patterns, if he had taken the time to study and understand the dynamics of the market he was trading,
Right.
he might have avoided those early losses.
Yeah.
And potentially stayed in the trade long enough to capture a significant profit when the market finally broke out of that range.
That's such a powerful lesson. It's not enough to just have a system. You need to understand that broader market context and be able to adapt as conditions change.
Context is king. Always remember that.
And that's why continuous learning and self-awareness are so crucial in trading.
Absolutely crucial.
We need to constantly be refining our understanding of the market, our strategies, and, ourselves.
Our own psychology is the most important tool in our trading arsenal.
Okay, we're back. And I don't know about you, but I'm feeling a lot more confident about facing those psychological challenges now.
Me too.
We've got all this wisdom from Mark Douglas.
He really is a master of the mental game.
He is. And, it's not just about avoiding those big emotional swings. It's also about uncovering those subtle biases.
Yes.
That can kind of sabotage our trades without us even realizing it.
It's like they're hiding in plain sight.
They are, and that's what I find so fascinating about all of this. It's like, we have these hidden beliefs and assumptions. They're just kind of lurking in the shadows of our minds,
Absolutely.
and they're influencing our decisions in ways that we don't even fully grasp.
It's like a subconscious sabotage.
So how do we kind of bring those biases to the surface?
Introspection is key. Take some time to really reflect on your past trading experiences. Look back at both your wins and losses and try to analyze the thought process and emotions that led to those outcomes.
So it's like journaling, but on a deeper level. It's not just about recording what happened, but really digging into the why behind our actions.
Exactly. Ask yourself the tough questions. Why did you enter that trade? What were your expectations? Did you stick to your plan? Or did you let emotions take over? How did you react when the trade moved against you? Were you disciplined? Or did you start chasing losses?
I can see how that could be a really uncomfortable exercise.
Yeah.
It's not always easy to confront our mistakes,
Yeah.
especially when they've cost us money. But I guess that's where the real learning happens, right?
Well, absolutely. By honestly analyzing our past mistakes, we can identify patterns in our behavior and start to understand the root causes of those errors.
Ah,
It all goes back to Douglas's principle of continually monitoring for susceptibility for making errors.
right.
It's not enough to just recognize the mistake. We have to understand the underlying beliefs and biases that led to it.
Okay, so let's say we've done that introspection. We've identified some of those hidden biases. What's the next step? How do we change those ingrained patterns of thinking and behaving?
Well, once you've identified a limiting belief, the next step is to challenge it. Ask yourself, is this belief really true? Is it serving me or is it holding me back?
So for example, can you give me an example of a common belief that might be sabotaging traders?
One that comes up a lot is the need to be right. Many traders have this deep-seated desire to prove they're smarter than the market, that they can predict every move.
But as we've talked about, that's just not realistic. The market is inherently unpredictable.
Exactly. And clinging to that need to be right can lead to all sorts of problems. You might hold on to losing trades for too long, hoping they'll eventually turn around. Or you might ignore your stop loss because you're convinced you know better than the market.
It's almost like our ego is getting in the way of making sound trading decisions.
It often is. And the key to overcoming this is to shift your focus from being right to being profitable.
Okay, that's a subtle but powerful distinction. It's not about trying to outsmart the market or predict the future. It's about managing your risk and making consistent, disciplined decisions based on your edge and your trading plan.
Right. And that's where Douglas's principles and rules of probability become so valuable. They provide a framework for making those decisions in a way that minimizes emotional interference and maximizes your chances of long-term success.
This has been an incredible deep dive. I feel like we've really uncovered some profound insights about the psychology of trading. What's the most important takeaway you'd like to leave our listener with?
I think the key takeaway is that mastering your mind is just as important as mastering the technical aspects of trading. It's an ongoing process of self-awareness, discipline, and continuous learning.
And it's a journey worth taking because, as we've seen, our psychology can either be our biggest obstacle or our greatest asset in the market.
It's true. And as you continue on your trading journey, remember this: the greatest trader is not the one who wins the most trades, but the one who manages their losses the best.
So it's not about avoiding losses altogether, which is impossible. It's about learning from them, minimizing their impact, and using them as opportunities for growth.
Exactly. Embrace the journey, stay disciplined, and never stop learning.
Wow, what a powerful message to end on. Well, we've reached the end of our deep dive today. But before we say goodbye, we want to leave you with a question to ponder. Knowing what you know now about the importance of trading psychology, what one small change could you make today to start developing greater consistency in your approach?
That's a great question to reflect on. Remember, even small changes, consistently applied, can lead to significant results over time.
Thank you so much for joining us on this deep dive into the fascinating world of trading psychology. We hope you've gained some valuable insights that will help you on your journey to becoming a more consistent and profitable trader.
Happy trading, everyone!